Hi, we're glad you're here. We think this series of videos will help you understand the positives and negatives of a reverse mortgage. We know a reverse mortgage isn't right for everyone, but for many it is the perfect solution. Once you watch the videos, we believe you'll have a better understanding of reverse mortgages and be able to make an educated decision about what's best for you. Hello. I'd like to have a frank discussion and address a delicate subject straight on. What happens when you die? Well, if you're a married couple who's taken out a reverse mortgage, here's what happens when only one of you dies. Nothing, as long as the remaining spouse is still living in the home. But when the last surviving spouse dies or permanently moves out of the house, then the loan is due and payable. From that point, essentially, your estate's given up to 12 months to pay the loan off. And that usually happens from the estate selling the home. But selling the home is not required. If the family wants to keep the house, they keep the house. But if the house is not sold, the estate will have to come up with the money to pay the reverse mortgage balance.
After the last surviving spouse dies, usually the estate is contacted about 3 months later. The lender verifies that there is a reasonable effort being made to sell the house or that the loan is going to be repaid from other funds. 6 months after the date of death, then the estate can get an additional 6-month extension. That's why we say that the estate essentially has 12 months to repay the loan. Reasonable effort means that the house is listed with a realtor at a reasonable price.
We mentioned that the loan is due when the last remaining spouse permanently leaves the house. What does permanently leave the house mean?
That means when the remaining spouse goes into a nursing home or moves in with one of the kids permanently. Now, sometimes what happens is the remaining spouse may go into a nursing home for a while. They don't know for sure if they are permanently leaving the house. So here's how that works.
When the remaining spouse has been out of the house 12 consecutive months, then they are deemed to have left the house permanently. That triggers the reverse mortgage to be due and payable. From that point, as I mentioned, the estate has essentially 12 months to repay the loan.
You may wonder how the lender knows if the person is living in the house. Each month you're going to get a monthly statement. It shows the balance owed on the reverse mortgage. If at some point that mail is returned to the lender, that would be a tip-off that the person is no longer living in the house. Additionally, some lenders may randomly drive by the house to see if it appears that it is still being lived in.
So, to recap, when the last surviving spouse dies or permanently leaves the house, the estate is given essentially 12 months to repay the loan. During that 12 months, the estate will need to show the lender that reasonable efforts being made to repay the loan. Thank you for watching, and please enjoy our other videos. We hope you'll call us. We're here to answer your questions and provide more information. We're here for you. And remember, life is a blessing. To get a better understanding of the positive and negatives of a reverse mortgage, you can view the entire series of free videos at rmeducator.com. We hope to see you there.